And it's great to have you join us on the only weekend business program on Channels Television. That's Capital Market, the first edition for 2024. I'm Ladi Williams. Great to have you here. Let's start off the program with an overview of major global stock markets performance at the end of the first trading week of January. Starting right there, we see the global markets. The trading week of 2024 mostly started negative. We see the U.S. markets following concerns of Eurozone inflation, which rebounded in December, and a mixture of economic reports across Asia. In Europe, the UK's FTSE 100 index dropped by 0.14%, while Germany's DAX and France's CAC index closed the day lower by 0.4%. For the Asia-Pacific region, we see Japan's Nikkei 225 ended the day as the lone gainer, up 0.27%. Shanghai Composite Index flopped at 0.85%. We see the Hang Seng Index, that shrank by 0.66%. However, the U.S. market indexes on Wall Street closed positive as investors share the latest jobs data, which shows that the payroll was more than economists expected at 216,000. In December, we see the Dow Jones Industrial Average ended the day 0.7% up. The S&P was higher by 0.18%, while the Nasdaq Composite notched up by 0.09%. However, major averages ended the 9-week win streak. That's for the week there. U.S. stocks gyrated on Friday as traders addressed and assessed incoming economic data to determine if and when the Federal Reserve will start cutting interest rates. Well, we see U.S. markets open the first week of January in the red, dragged down by losses from big tech companies such as Apple. We see the weekly performance there. The Dow Jones is down 0.59%, close the week. The Nasdaq was the biggest loser, 3.25% down, and the S&P 500, 1.52%. Let's bring in Olumide Adesina now, financial market analyst. Hello, Olumide, great to have you.
Ladi. Happy New Year.
Happy New Year. So 9 weeks of gains snapped there in U.S. markets. Is it a sign of things to come or just good old profit taking?
I think one needs to look at the broader index to really affirm what's really going on. But one thing I can confirm to you, Ladi, is that it's been an awful week. In fact, if you look at it on a weekly basis, this is the worst start since 2003. And that was pretty much highlighted by the fact that we saw Apple losing the $3 billion market valuation, dropping to about 2.8. And that was pretty much on the downgrade by the British Tier 1 investment bank, Barclays, highlighting the fact that they see soft demand in app and in iPhone. And also, if you look at recent sentiments that Department of Justice might look into Apple's pay and also the way Apple Watch is being synchronized mainly with the Apple ecosystem, that also weighed on the stock. And, Tesla, another interesting stock in 2023, Tesla posted almost more than 100% gain. But right now, Tesla is having a misrun, and that's pretty much due to three reasons. First of all, BYD is now the biggest electric vehicle producer in Q4, despite the fact Tesla smashed its latest car production estimate. The stock had been unable to break above the $250 resistance level. And pretty much also the company announced that they were recalling 1.6 million cars. That also weighed on the stock. So it's really been a form of negativity. And I think what crowned it all was Microsoft. Microsoft, OpenAI, they face legal issues, and that also widened on the Magnificent Seven, these companies that really moved the stock market. So it's really a more of like bad news for the top holders. Elon Musk is down $10 billion this week, and his market, his world valuation is now about $219 billion. We only saw Warren Buffett gaining top on a weekly gain, and that was pretty much because Berkshire Hathaway has a well diversified. So it's really a bad week for institutional and retail investors in the United States.
Right, and I'm wondering if the Magnificent Seven will stay magnificent in the U.S. in 2024, but we'll keep watching out for that. But what market-moving data should investors look out for next week?
I think right now jobs report came out, so I think what the next important data will be inflation, the CPI, how because that's one of the most important economic readings after the employment data. So investors definitely will gauge, because though the US Fed had already highlighted that in 2024 they're going to moderate on interest rate hike. So we don't see that aggressive approach, but any um, any increase in inflation numbers might be bad for stocks.
But all this chatter about possible rate cuts in 2024, is it safe to say the U.S. dollar might have a weak 2024?
It's not safe, because I looked at Morgan Stanley and JP Morgan's outlook on the dollar. You compare with emerging markets, the United States is still better shaped than many countries, including the emerging markets like China and Africa. And that pretty much because we're still seeing growing concerns that all is not well in the property market in China, and dollarization of the African continent with slow economic growth has weighed on the. So while you could say the Fed court should definitely portray a weaker dollar, it seems that the competitors around the American ecosystem are doing much more worse.
All right, we'll be looking out for how the markets shape for next week. Thank you so much for joining us on Limited Edition of Financial Market Analyst. Thank you.
Thank you for having me.
All right, and back home at the unlisted securities market, the NASD OTC Exchange Index ended the week with a 0.16% gain for the first week of January, as the market's total value also notched up by 0.15% to 1.25 trillion naira. At the same time, the volume of securities traded in 4 sessions this week climbed by 9.44% to 10.28 million, while the value of transactions rose by 8% to 73.69 million naira in 34 deals carried out from 12 securities. Double One, formerly known as Mobile, topped a list of 5 gainers with a 9.44% advance, while NIPCO and Central Securities Clearing System were the only losers for the week. And for the domestic stock market, it ended the first trading week of 2024 and in January strongly positive, recorded 3 milestones within the 4 trading sessions after resuming from the New Year holiday with a hangover of wins. We see right there the impact of bargain hunting for blue chips such as MTN Nigeria, Airtel Africa, and the banking sector components drove the All-Share Index to a new historic high of more than 79,000 points, and the market cap at over 43 trillion naira, with a year-to-date performance at 6.54%. Performance on the sectoral indexes table was also positive, particularly from the insurance and banking counter, which gained 14 and 10% accordingly. Transcorp was the top out of 88 gainers with more than 46% gain on its share price. CNI Leasing led 16 other losers with 39.64% loss, while the trio of Fidelity Bank, FCMB, and Sterling Bank were the major contributors to a total of 3.32 billion equities traded this week. Well, as investors plan and position for investment opportunities in 2024, let's get a sense of what to expect in the fixed income market for 2024. Joining us now is Bankole Odusoya, Chief Dealer at Polaris Bank, right here in the studio, not via Zoom. Great to have you.
Happy New Year, laddie.
Fantastic. So from all you've heard earlier, we see that risk did really well in 2023, risk assets. Into 2024, we're seeing the NGX still rallying on, at this time. Paint a picture for us, the fixed income market, that was quite quiet in 2023, but were there any significant moments in 2023 for the fixed income market?
It was quite eventful towards the end, immediately after the elections, and then we had a change of leadership in the central bank. There were policy statements by way of communique, and then we started seeing some action by way of collapsing the entire FX window. We had about 4 or 5 that were active. Right now we have just one. It was called the I&E, and then it was molded into NAFEM, Nigerian Autonomous Foreign Exchange Window. So that's where we are at. Of course, there's still paucity of fund, but right now we're all referring to one rate and not just looking at four. And then for fixed income, what happened was that in August, there were two open market operations, T-bills issuance by the central bank. The aim was to kind of, yield to demand for higher interest rates, and then it came as about 16 to 17%, just twice. There was a pause in that, and then in November and December, the central bank resumed issuing OMO. So we expect that going into 2024, it will become more structured, probably by way of, let's say, weekly or every 2 weeks, something like that. So that was the game changer. And then yields went up, market became more active. What had happened in H1 was that yields were low, market was very quiet because a lot of fund holders, especially outside banking, would rather invest in FX for the returns and then for speculative returns. But in order for government to counter that, what they did was to yield to interest. Interest rates from treasury bills went from 9 to 10%, then spiked up to as 16.5 on Nigerian treasury bills. For bond discount, for OMO discount, it got to 17.5. The effective yield of that is 20. So that brought back some local participants. We have not seen more of the foreign portfolio investors coming yet. Of course, it was election year, it was year end, just like you're saying about the US markets, and then what's likely to happen with drop in interest rates over there. There's likely to be some risk takers coming in from the FPI side back into the economy. Most of them had left way back 2020 COVID. They had some funds stuck in here. They got OMO built, some way of compensation, but it's been a story of paucity of effects affecting them, and then they're not sure of where rates could be or where rates are headed to. But now, if you look at the budget, you see that we're at 800, very close to reality. And so, if the government can manage, the revenue stream, especially with crude oil theft, we expect that there'll be some stability.
I'm talking about the spending plan for 2024. If we compare with revenue, the aggregate revenue expectations there for 2024, we see at 18.32 trillion. If you can bring up that data, we see that 2023 was at 11 trillion. That was about 65%, change. And we see for oil revenue, 2.29 was for 2023. So at this point, the government is definitely looking for revenue to fund this budget, and the expectations that they're going to come into the fixed income market.
Oh, yes.
What are you seeing?
Okay, so last year was an election year, like I said. We can't overemphasize that. There was a lot of issuance of bonds, more than what was put out in the calendar, where the government would plan to borrow 400 billion a month, and they would go as high as selling as high as 550 or 700. That happened a lot, especially in H2. Going into 2024, the difference here is that we have changed our benchmark rate from 435, which was used for the 2023 budget, to 800, almost double. So what has happened is that it seems as if the revenue expected has doubled. Crude oil production isn't doubling anyway, given the OPEC cuts, and but what we are doing is that we have adjusted the FX rate. The FX gain there is doubling, so that's why if you look at the budget breakdown itself, 28 trillion. The deficit this time around has dropped from about 14 to 9. So that speaks to how much they will be willing to borrow, because already the National Assembly, along with this budget passage, has already approved $7 billion borrowing plan from external borrowing in dollars. So what will be left by way of dollar will be like 4 billion, another 4 billion, which will be 3.75, and will be borrowed. If you break that down, it won't be more. It won't be up to what was issued last year. Right. So we don't expect aggressive borrowing on the local side, except if the plan to raise the 7 billion as approved, has issues, especially with pricing. That's where we are expecting issues, because Afrexim has availed us about 2.250 out of the 2.5 of agreed. The pricing is an issue because it's over 11%. If you look at all Nigerian Eurobonds, you would notice that the coupons of all those eurobonds from 2016 to date range from between 6 to below 9. I'm not sure if Nigeria has a 9% instrument. Angola has a 9.5.
Right.
So going to 11.5, it speaks to sustainability, especially on debt servicing. Already, we were using most of our revenue to fund debt servicing.
Right.
Then borrowing more at above 11, calls for concern.
Yeah.
So they have a plan to borrow, to stabilize the currency, like we said, and then attract FPIs, especially through easing that we are seeing on the crypto side, excluding the banks, but allowing those cryptocurrency economy, to at least kickstart. But the issue is the pricing of the foreign debt.
Exactly. Pricing definitely is a big issue at this moment. But we're going to continue the conversation, right after the break to see how it's going to shape up for 2024, how companies are going to even participate in this market. We'll continue the conversation right after this break. This stay with us, this is Capital Market. Welcome back. We're still reviewing the fixed income market in 2023 and looking out for what to expect in 2024. I still have with me right here in the studio Mr. Bankole Odusanya, Chief Dealer at Polaris Bank. Thank you for staying on. So, looking at the budget there, we see that it's quite a big deficit right there, and this has to be funded. At the end of the day, so that this budget can actually perform well, and so that we can actually get to that $1 trillion economy that we're all thriving for, at this time. But talk to me, about, the private sector. At the end of the day, they also need funding. Is there a risk that the federal government might crowd them out, of this market in 2024?
Yes, that risk came to the fore in H2, where government actually started paying more on OMO bills, Nigerian Treasury bills as high as 16.5, 15. That was effective yield 17.5. I mean, as a bank, we were wondering, why do I have to take a risk to the real sector at 22, 23? But what has happened is that the CBN in August brought out the communique and insisted that we stick to the stipulation or the statutory LDR, loans to deposit rate, which is about 65% on the minimum. So if you do not meet that statutory benchmark, the gap will then be taken away from you at 0%. So I must confess that banks have been pushing up more risk assets. Of course, what has happened is that it's probably not trickling down to the small and medium scale enterprises who actually would be running the economy directly. The impact will be more felt if a lot more credit went to the small and medium scale businesses. Right now, I think it's more, what I've seen so far is that we've seen more of such credit go to distributors of energy, petrol. A lot of them got a lot of funds to bring in petrol and all that. But to the small and medium scale, it's still a challenge, especially with data security and sustainability of such a scheme. So the government itself, on the other hand, through BOI and various agencies, can also come in to guarantee the bank's funds going to the SMEs. Of course, the SMEDAN and all those agencies working on that.
Because these small businesses, they employ a huge
the impact will be felt
size of this population at about 95%.
Oh, yes.
If I'm not mistaken. So they need to get some of this funding, going into 24. But at the end of the day, we're hearing talks about rate cuts in other developed markets at this time. But here, I don't think we can actually think about rate cuts.
We're not
just yet.
We're not looking at rate cuts.
Right.
I'll speak to inflation at 28%. Food inflation is already at 33%. If you go track back 24 months, you see that the CPI, the inflation figure itself, tracks food, which is the major element in our own basket. In the US, the major element is fuel prices, that's energy prices. Here, it's food. So if you're thinking that it's a possibility to hit 30 or 33, I don't see the Monetary Policy Committee reducing rates. The next meeting should be on the 23rd of January. We did not have two meetings in September and November.
Even though the CBN, they say they fulfilled.
Oh yes, they spoke
the
to
meetings for the 2023.
The governor spoke to the CIB and released, a statement after that. But going into this year, you would expect a notch up on MPR and probably some tweaking of the asymmetric window in which that then speaks to how much we can, at what rate we can access money or place with the central bank.
But with all of the rate hikes we've seen in Nigeria, it seems not to have any impact on inflation.
Yeah, so the rate hikes probably speaks to the demand side of our challenge, inflation challenge. Nigeria has like a double-edged sword problem with inflation because there's also the cost side to it. We're talking of food being produced in the middle belt. We're talking of distribution of the food, storage, and then security issues. So that affects the amount of harvest, transportation of the food, spoilage, affecting the cost. So by the time the food gets here, we don't have the processing capacity yet. The deficit in infrastructure is still an issue that needs to be addressed so that you can process, halfway and then transport probably via rail down south to the markets where we're then pre-packaging and then exporting. So we're not just solving a food problem locally, we're also solving exchange gains issue. So basically that's a larger macro problem that needs to be resolved by the government. But I must confess the central bank is working heavily on ensuring that the banks issue loans, but they need to do more work and ensure that that is cascaded to the small and medium scale businesses.
So at the end of the day, looking at the situation in Nigeria now, you did mention it's a supply side issue. So will it be wrong to look away from rates, at this point? That's talking about raising rates. Would it be wrong to hold, and try to tackle, let other agencies tackle other issues, that's making food, more expensive instead of raising rates?
I was careful in using the language notch up. We're currently at 18.75.
Right.
We could see maybe a 19%, just to tackle that. And then on the other side, what has to happen is we need to ensure that the food basket is safe, and then loans are targeted to specific, let's say, railway that ensures that food is then channeled quicker and safer without all these tolls being put on the farmers and the distributors. So basically it's a double-edged sword. Like I said, you can't just lean on rates only. That's why I use the word notch up, because we're expecting that in Q1 inflation could trend along with food prices, which is still going up. It's the trend. Go and look at the 24-month trend. You'll notice that the CPI in itself leans heavily on the direction of the food inflation figure, which is already at 33.
So if we solve food,
we are in Nigeria, definitely prices will go down generally.
So no need to look at rates at this time.
So, yes.
All right, so 2024, I'm sure some investors are looking for where to pack most of their funds into to make gains in 2024. What are you seeing for, is it going to be risk off or risk on sentiment still for 2023 in Nigeria? Do you see the fixed income market being the place to go in 2024?
Oh, yes. Because of the way we ended 2023, effective yield of 18-19% is not bad at all. We expect that the largest fund holders, the PFAs, and the other participants in the private sector, non-banking ones, of course, diversify their portfolio. We know that there's a lot of interest in Nigeria NGX, and that's because of the money supply in itself. Of course, all the ways and means has found its way into the economy. Some have passed through the bank, of course, some will. Some outside in the non-banking, we call them unbanked.
Unbanked.
Yeah,
right.
So that pushes inflation in itself. But some of that money will get to the NGX and the fixed income market. That drags down yield when people show interest and then demand for more. When people are demanding for rates at 15 in desperation, that drags down yield and pushes up prices, just like we're seeing in the NGX. So we expect that to continue in this quarter. Especially with anticipated banking stock performance. Yes, because there's a lot of money that has passed through the banks. The balance sheets are bloated and larger. The government has had to do a lot of work to buy the CBN to take excess funds that they are not lending to the real sector. So going into 2024, there'll be more CRR. It used to be weekly. What we're seeing now is daily CRR checks. So because if you're not meeting your lending requirements to the real sector, the central bank simply takes the money, and the checks are no longer weekly, it's daily now. So it's a lot of work.
So the banks have a lot to do in 2024.
In managing funds.
It'll be great, let the real sector get all of that funding, so we can get some, development and some respite for them. Thank you so much for coming on, and we're definitely hoping for a great 2024. Mr. Bankole Dusoye as a chief dealer at Polaris Bank. Thank you so much. All right, let's get a check on some top stories now. See, Nigeria is set to launch its first crypto-regulated Naira stablecoin called the CNGN. The central bank has approved its takeoff, which is set for February the 27th. This comes after the financial market regulator recently lifted its restrictions on cryptocurrency transactions. The new stablecoin, which is being developed by a consortium of Nigerian banks, fintechs, and blockchain businesses, is expected to be consistent with regulations set by stakeholders and controlled by the controlled Naira stablecoin. And the Lagos State government, the House of Assembly has passed the 2.26 trillion Naira budget for 2024, presented by Governor Babajide Sanwo-Olu last year. The spending plan, which comprises 58% of capital expenditure and 42% recurrent expenditure, was approved after a unanimous voice vote by the lawmakers. Prior to its passage, the chairman of the Joint Committee on Budget and Finance, Mr. Olumo, presented a report of the committee which recommended that the Public Works Corporation and the Water Corporation and state-owned tertiary institutions be placed in first-line charge to enable them perform optimally. All right, so that's the show today. Thank you so much for watching for the first training week of 2024. Definitely looking out for the second week. Thank you for watching. I'm Ladi Williams from me and the team right here at Channels HQ. It's bye for now.